finally, the 10th way you can invest $1,000. And yes, I'm going to get a lot of flack for this, but I don't mind, because not mentioning this option is similar to a physician not giving their patient all the possible options, because some patients may find it too risky, but then on the other hand, it may be life-changing for others. So the 10th way you can invest $1,000 is to invest in cryptocurrencies. Yes, we went there. You have probably heard the buzz. Is cryptocurrency a hype, or is it the future of money? And there is a lot that can be said for cryptocurrencies. Some people believe and say it is the devil's currency. Others say it is a scam, whilst others say it is a speculative investment asset, which inevitably is the future of money. Regardless of what group you fall into, I'm guessing that you've heard some success stories of individuals who have doubled their monies in a short space of time and made millions. If you are only looking to partake in the performance of the market, then an index fund is a great way to go. It follows a passive investment strategy, which means that it's not trying to beat the market, it just matches it. Number 2 is a diversified portfolio. The second thing about index funds is that you get the advantage of safety in numbers, because you don't have to know or be an expert at picking stocks. By buying an index fund, you automatically get access to widely diversified stocks that cover different industries as well as sectors. And so if you're not interested in researching tens or hundreds of stocks, an index fund offers built-in diversification. So to buy an index fund, you will need a brokerage or stocks and shares account. Here are 3 examples of S&P 500 index funds to get you started on your research. The Schwab S&P 500 Index Fund, the Fidelity 500 Index Fund, and the Vanguard 500 Index Fund. So here are 2 examples of S&P 500 ETFs to get you started on your research. The SPDR, or as we call it, the Spider S&P 500 ETF, and the Vanguard S&P 500 ETF. The third way you can invest your $1,000 is through bonds. A bond is basically a loan that you give to a company or a government. In return, they promise to pay you back later with interest. So think of it like you are the bank and they are borrowing your money. Now, why would you consider investing in bonds? Well, because bonds are often more stable than stocks, i.e. they don't see the same drastic volatility that stock markets tend to experience. And historically, when markets are shaky or choppy or volatile, bonds tend to smooth out that ride a little bit. And plus, they pay you regular interest. So that's kind of a paycheck for your investments. And over time, they tend to be fantastic diversifiers for a portfolio that has a heavy allocation to stocks. They can generate income to help you supplement your salary or even fund your retirement. Bonds have different levels of safeness, and there is what we call investment-grade bonds, which are the safest type of bonds you can find. And you also have sub-investment grade bonds, which are lower down the spectrum and are considered more risky. So how do you buy bonds? Well, similar to index funds and ETFs, you can buy bonds through a brokerage account. And what's more is that if you cannot decide on which bonds to buy, well, you're in luck, because there are bond ETFs and bond index funds out there. The 5th way that you can invest your $1,000 is to invest in money market funds.